In this video blog, I'd like to talk about tax debt and bankruptcy. If you have significant tax liability, there are a number of ways to deal with that tax liability. The first is obviously to pay all of the tax liability off. The second is to enter into what is called an installment agreement with the Internal Revenue Service or with the applicable taxing agency, in which case you would make a certain monthly payment for over a period of time until the tax liability is wiped out. The disadvantage of an installment agreement is that interest continues to accrue. So most people find it's very difficult to pay the tax liability off over a reasonable period of time because the interest continues to accrue. Third option that you have is what is called an offer and compromise. In an offer and compromise situation, you would submit an application to, for example, the Internal Revenue Service, and they would take a look at the overall financial picture, the asset structure, to determine the collectability of the debt. If they feel that there aren't sufficient assets or earning power to pay back all of the tax debt, they will sometimes forgive some of the interest or penalties, or all of the interest or penalties, or depending on the circumstances, even some of the principal amount of tax owed, and then the balance would have to be paid either through an installment agreement or in a lump sum payment. The fourth option that you have is a Chapter 13 bankruptcy case. In a Chapter 13 bankruptcy case, it's basically automatic. You put down the amount that you owe, you divide that amount by 60, and then you pay that amount over 5 years, and at the end of 5 years all of the tax is paid. The significant benefit of Chapter 13 is first, the interest stops accruing during the Chapter 13 process. The second significant benefit is you can propose repaying the tax at 0% interest. The third benefit is, unlike the installment agreement or the offers in compromise, the client is in significant control of the process, and if the IRS or the other taxing agency doesn't approve of the manner in which the amount is being paid back, they can object, in which case a judge decides. Another advantage of proceeding through bankruptcy is the IRS or the other taxing agency cannot levy on any bank accounts, they can't garnish wages, they can't send threatening letters, they can't file liens. So the whole process is much more orderly and much more relaxed. Now some tax debt can be forgiven in a bankruptcy process. There's basically four tests that have to be met. First, the tax has to be more than 3 years old, and it's measured by the date at which the return should have been filed. So for example, for 2008 tax debt, the return would normally be filed on April 15th of 2009, so the 3-year period starts running from then. If you requested an extension, then the 3-year period does not begin running until October of that year. So for 2008 debt with an extension, the 3-year statute of limitations would not start running until October of 2009. So the earliest you could file your bankruptcy petition and have the debt eligible for discharge would be the end of October in 2012. So here we are in 2013, which means that as of April 15th, 2009 tax debt can be treated like a credit card debt and wiped out in bankruptcy. Now one caveat, the only debt that can be wiped out in bankruptcy is debt owed to the federal government. Tax debt owed to the state of California of whatever year cannot be wiped out. The second element for the dischargeability of federal taxes is the tax returns have to have been filed at least 2 years prior to filing the case. The third element is, as a general rule, the tax can't have been reassessed within 240 days of filing. Now, the reassessment typically does not come up in individual cases. 2009 tax return is filed. The IRS will typically get the tax assessed or the issue resolved long before a couple of years down the road, so that element is typically easily met. Now, the next element is the statute of limitations is told for any period of time that the individual is in an offer and compromise process with the Internal Revenue Service. So, for example, if you have 2009 tax liability and you filed your taxes in April of 2010, but then entered into an offer and compromise process that took 6 months, then the statute of limitations would not expire in April of 2013. It would be an additional 6 months plus a short administrative period after that before you could file your bankruptcy petition and wipe out the debt. Now, the last element that we look at in analysis of tax liability is whether or not a tax lien has been filed. If a lien has been filed, then in the bankruptcy, the individual obligation on the debt can be wiped out, but the tax lien will survive. So, for example, if the individual has a tax lien filed against them and they own real property, then while the bankruptcy may wipe out the personal responsibility to repay that tax, the IRS can still look to the property to satisfy the debt. Now, if the property is hopelessly underwater, then there's not going to be any equity in the near term to satisfy the tax liability, so the tax lien really doesn't have any effect. Or if the individual doesn't own any property, then the tax lien is not going to attach to anything. But if the individual obtains property in the future, then taxes can be a problem. But in sum, bankruptcy really offers the most orderly and, in the vast majority of cases, the most effective way to deal with tax liability. With an installment payment, interest continues to accrue. In an offer and compromise situation, often the relief is minimal, but in the bankruptcy process, the taxpayer retains a significant amount of control, and the tax debt is resolved in a very orderly process.